Hey guys, what's up? I'm Erin and welcome back to the channel. Are we stuck in a frozen housing market with home buyers and sellers at a standstill? With high mortgage rates and limited inventory, it sure feels that way. And why are mortgage rates still high, despite the Federal Reserve starting to cut rates? What does this mean if you're in the market to buy a home? Mortgage rates are still much higher than we've seen in recent history, sitting in the 6 to 7% range. The Federal Reserve made its first round of rate cuts back in September, at which point many of us eagerly awaited mortgage rates to fall, only to be shocked by mortgage rates actually increasing after the first round of rate cuts. So why is that? The Fed directly influences short-term rates, like bank-to-bank lending. However, long-term rates, like mortgage rates, are tied to the 10-year Treasury note, a government bond with a fixed yield. Since it's a safe investment, its yield serves as a benchmark for long-term loans, including mortgages. Broadly speaking, when there's a lot of uncertainty within an economy, people tend to buy more treasuries because they want to lock in a guaranteed interest rate. This will bring down the yield of the treasuries, and this will also tend to bring down mortgage rates. On the other hand, if people have a lot of optimism with what might happen in an economy, or if they tend to have fears that inflation is going to stubbornly stick around, they tend to sell treasuries and pursue a higher return elsewhere, like with the stock market. This can bring up the yield on treasuries and it brings up mortgage rates. So despite the Federal Reserve beginning to make rate cuts, there are still fears that inflation hasn't fully yet been dealt with, and this has led to the yield on the 10-year Treasury remaining high. And that means that mortgage rates have tended to remain high because mortgages follow the 10-year Treasury, not directly the federal funds rate. The good news is that Fannie Mae is predicting that the 30-year fixed mortgage rate should be closer to 6.2% by the end of the year and hover around 5.7% by 2025. These may not feel like big moves, but it can be a big deal for home buyers. Currently, 30-year mortgage rates are about 6.625%. For a $400,000 loan, that's a $2,890 monthly payment. At 5.7%, it drops to $2,651, a $239 monthly savings, and over $86,000 less in interest over the course of a life of a loan. These small interest rate adjustments really do matter. And recently, the Federal Reserve Chair, Jerome Powell, went on to say that the problem with the housing market is not really something that the Fed can really fix, because the primary issue with housing itself isn't simply higher than expected mortgage rates. It's a limited supply of houses. Many homeowners locked in an interest rate of 2 or 3%, and this can make it unappealing to sell their current home and take on a new mortgage at a rate of over 6%. This is limiting the number of homes that are coming to the market. For many, this would mean they would have to downgrade their home, and many people don't want to do that for obvious reasons. So a lot of people feel kind of trapped in their current home because of the interest rate they have. So for a lot of homeowners, there really isn't this incentive to put their home on the market unless there's a pressing need to sell, like maybe a job location. Without that, there just isn't a big incentive to move right now. Zillow estimates that we have a housing shortage of about 4.5 million homes as of 2022, and that the shortage is only getting worse. If inflation improves, that can bring down the yield on treasuries and make mortgage rates more favorable. However, more favorable mortgage rates can increase demand and competition in the marketplace for homes, and that can actually drive up home prices. Higher interest rates can make housing seem unaffordable, but lower rates could still have a way of driving up home prices as we deal with a limited supply, and driving up home prices still brings about an affordability issue. The good news is that we are starting to see small improvements in the housing market. Mortgage rates are inching downward and supply is inching upward. The recent strength in purchase activity continues, supported by lower rates and higher inventory levels, which is giving prospective buyers more options compared to earlier in the year. And while these changes are modest, they are seemingly attempting to thaw what has otherwise been described as a frozen housing market. Now, if you are not interested in buying a home right now, or you're currently in a home that you see yourself in for the long term, movement in the housing market may not be of much interest to you. However, if you're planning on selling your home in the near future, or you're looking to buy a home in the near future, you might be watching this market very closely. If you're in that situation, I think it can be really helpful to remember that today's market won't last forever. If you're ready to buy a home, you can lock in a rate today and you can always refinance down the road. Just because rates today are above 6%, that doesn't mean that's what they'll be 4, 5, or 6 years down the road. Now, of course, we don't have a crystal ball. We can't guarantee what's going to happen with interest rates, but it's likely that they're going to change over time. And if you have a home that you're eyeing, it is likely that that home is going to be more expensive in 5 or 6 years' time. So if you're ready to buy, I think now is a great time, assuming you're in a good position to buy a home. There's only been a few times in our nation's history where home prices have actually declined, so I don't expect home prices to go down. Before you go buy a home, I think you should ask yourself these 3 questions. What can I comfortably afford each month? Ideally, I think your home and all home-related expenses would fit within 25% of your gross income. A more general rule of thumb would expand that to 30% of your budget. I tend to be a little bit more conservative because I want more wiggle room in my budget. I want room in my budget to do other things outside of living in my home. I don't want to be house rich and cash poor. And the key here is that this includes your home and home-related expenses. So it includes your insurance and your HOA and all home-related items, because you still want to have room within your budget to go buy food and take a vacation and put money into savings and investments. You want to do all those other important things as well. How much do I have for a down payment and closing costs? I think there's a lot of flexibility when it comes to determining your down payment. Traditional advice will say that you need a 20% down payment, and there's nothing wrong with that, but I don't think you always have to stick to it to a T. I put 10% down when I bought my home, and I was perfectly comfortable with that. Just know if you put under that 20%, in most cases, you will have PMI factored into your monthly payment, so make sure you budget for that accordingly. Also, make sure you get an accurate estimate of what your closing costs are going to be, because those can be significant. You want to be able to cover these costs without completely depleting your emergency savings, because what happens if you go and buy your home, then an emergency happens in life and you have nothing to fall back on. Don't go putting yourself in a risky financial position just to buy a home. Also, make sure that you have the funds necessary to set up a home. Maybe there are repairs to be made to this home, maybe you have to buy furniture. All of these costs matter and they tend to add up. Finally, am I prepared for the ongoing costs of homeownership? The general rule of thumb is that home maintenance and repairs run anywhere from 1 to 3% of a home's cost on an annual basis. Some years are more expensive than others. It's just important to keep in mind that the cost to own a home is more than that mortgage, and you want to make sure that you have funds to dip into in case something pops up. What if you have to replace a furnace or your windows or the roof? This money has to come from somewhere if these repairs have to be made. If you can solidly and comfortably answer yes to all of these questions and you're in a position where you want to buy a home, then you should go buy a home that fits within your budget. Also, keep in mind, you don't need to own a home in order to achieve financial success. I rented for 10 years and built a 7-figure net worth prior to ever buying a home. Yes, homeownership comes with perks like fixed housing costs, the ability to build equity and appreciation over time, but it is not the only path to wealth. There are also perks to not owning a home. There's a lot of flexibility with your life when you aren't tied to one location. There's absolutely nothing wrong with renting. I really don't like to push that feeling of you have to be a homeowner in order to be financially successful. Because in our society, I really do feel like being a homeowner and financially successful often are pushed as going hand in hand, but I think that message can be a disservice. Homeownership comes with a lot of expenses, and it is not a guaranteed path to wealth. If you are not yet a homeowner, or if you're simply not interested in being a homeowner, you can still build wealth. You can set money aside into your company's 401k, an IRA, or into brokerage accounts. Setting money aside for your future and investing is a great way to build wealth over time. And even if you want to invest in real estate outside of owning a home, there are great ways to do that. For example, you could invest in REITs or real estate investment trusts. All of the major brokerage houses tend to offer them as index funds or ETFs, and this can be an easy way to get into real estate for a very low cost. And it's a great way to get invested without having to deal with any of the hassles or the headaches that come along with being a landlord. Buying a home is a big decision, and it's certainly not the only path to financial success. When you're a home buyer, it can bring stability and it allows you to build equity within a home, all of which can be amazing things. But you can certainly still build financial success as a renter who just invests over time. What are you planning to do with your housing situation in the near future? Is the housing market something you're watching closely? Are you planning on selling a home or buying a home? Let me know your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.